Todd Martin's here. He's an Asia equity strategist at Societe Generale. Todd, what are you making of all this?
Well, we're now in the capitulation phase for the markets. I think the U.S. government's in denial. I think the fact that you're getting critical comments from the Treasury on the S&P and the comments from Obama overnight tells us that we're not quite in the policy response and moving towards solutions. We're dealing with global imbalances. We're dealing with Asia that has had inflationary problems for the last 12 months, which I think are starting to subside. So, yeah, these are interesting markets and creates a lot of opportunity.
Yeah, that's what I'm saying. Out of every crisis does come an opportunity. Yes. But I just want to dwell on what's happening out there right now. I mean, you mentioned capitulation phase. How long does it go on for?
I think it can go on for the next couple of weeks until we end up with a policy response that's for grown-ups and and makes sense for dealing with the problems.
Okay.
We need one thing. We need jobs growth in the U.S. So I think, that's going to happen, I think, when Bernanke goes into Jackson Hole. And I think on the 24th and 25th of August, we're going to get a QE3 of some sort. It's going to be at least as big as QE2, at least $600 billion. But I think it's going to be attached to a jobs growth package of some sort. They're going to have to convince and bring in politicians that's going to address the problems that they've had so far, which has been a stuttering recovery, but not necessarily a recovery that's created jobs and has decreased unemployment. Secondly, I would say that now is the opportunity for people to start accumulating stocks in China and India. We've been underweight China since the end of last year. And I think the reason why now is the time is that we did see a huge outperformance from China and India during QE2. China outperformed the world by 90% and India by 60%. And the reason why it should happen now is that inflationary expectations are starting to come off for emerging markets. We're starting to get deflationary risks for the rest of the world, which is why Bernanke is going to do QE3, or why I think it's much more likely that he's going to do QE3.
Well, and you're saying it's going to come with a package of labour growth measures here as well, but doesn't, going back to printing more money, smack of what happened before, and you didn't get what you wanted that time? Where are you going to get it this time?
Well, I think that's why you need a jobs growth package attached to it. If you just create money, you get what happened last time, which is a debasing in the currency, which technically makes the U.S. more export competitive. But it also creates capital flight. Over QE2, we had $60 billion of capital flight to emerging markets, of which $40 billion was to equities. I think that percentage is going to go higher during a QE3. So you get more capital inflows, more issues for rising currencies in Asia, and more complaints from central banks dealing with excess liquidity. But now is the time to start accumulating stocks out here, in particular cheap blue chips.
Right, you're saying here, I think you're using the term rescreening for QE3. So what are the stocks you look at?
Well, we're looking at stocks that are cheap on a 5-year basis, have earnings momentum, and we've been seeing earnings upgrades. So we've been looking at stocks like Tencent, Baidu.
Growth stocks, actually.
Growth stocks, yes, but there's also small, mid-caps. I'll give you an example. Singamas, which our joint venture partner, Japan Invest, has a buy on, is on 4.3 next year's earnings. Now, if you believe those earnings, but
you've got to believe those earnings.
But go back 10 years, it's on 11 times 2001 earnings. And back then, the stock was at 36 cents. Right now, it's 2.12. That could be a 2 or 3 bagger in the next 12, 24 months.
Okay, what about safer bets on the defensive side of things? There are companies which are churning out money.
Well, I would, you see, financials is one of the areas that I'm getting a lot of questions on in China. Would say that valuations are getting more interesting. In particular, the insurers have been completely bombed out. I'm starting to screen the insurance. Even financials, if they start a stimulus plan, I'd be looking in there. Consumer cyclicals, I think you're going to end up with China starting to take off some of their tightening measures as the rest of the world slows. It's going to be stimulating internal demand, so I'll be looking in those areas.
Yeah, the data we're expecting on the bottom of the hour, producer price, consumer price, inflation data, is going to be key, isn't it?
SG is looking for 6.3, consensus is looking for 6.4. The key is if we get a month-on-month, year-on-year improvement it's a sign that we've now seen the worst on a year-on-year CPI basis, 6.4, 6.3. It's the beginning of CPI starting to come off, which means no more tightening, which means people will start seeing that China is quite possibly, and India for that matter, is now time to start accumulating. China is on 8 times earnings next year. Malaysia and Singapore are in the 13 range on a 50 to 60% premium. It shows you how far China has fallen relative to Asia. India as well is much, much cheaper than it was 12 months ago.
But inflation there is even more rampant than it is in China.
Yes, it is. And that's the reason why I think it has suffered a little bit more. Valuations there have always been higher. They've always achieved higher return on capital. But if you look at India relative to MSCI World, that is the market that has really started to accelerate on a relative basis over the last week or two.
Todd, pleasure having you on the programme as ever. Todd Martin there from Société Générale.